the current banking situation in the United States?
Yeah, so like, it, why is that in trouble right now? We're seeing like a lot of banks failing, and we did also like share this on Discord, which I'm gonna pull
Mhm.
up and
Nice.
call it. They were failing, and we
Yep.
guessed that like Western Alliance might be next, MCB might be after that.
Yeah.
That's also our guess, but what do you know? Like,
I think on
basically
Friday that was
Western.
proven correctly. The WAL
Yeah,
that
it's
tanked.
here you go. We
Yep,
we
Friday.
we guessed, and that went under, and and why is that, right? Like what?
It's
Uh, like why are they in trouble? Why are they in trouble?
overwhelmingly what I'm seeing in these bank cases where the Federal Reserve is stepping in is it's. I mean, there's a lot of narratives that get thrown around, but ultimately it's just bad banking practice. What a lot
Yeah,
of these banks were doing was taking customer funds or funds that they need to have available for their debtors, like people who deposit, and want to withdraw their money at some point. They
yeah.
took that money, and back when the Federal Reserve interest rate was like 3.2, 3, 4% or whatever for a 10-year bond, you would
Hmm.
get these banks taking customer money, locking it into these 10-year bonds for like this 4% yield, and then putting the money effectively off the table for 10 years, because why would you need liquid money? You're only a bank. It's like, but so they're
But they didn't.
basically
It's just
gambling
bad
gambling
risk
with people's money.
management.
It's really, really poor risk management, especially considering that there's much shorter term instruments to produce yield. And the difference between the yield, like for example, those bonds that are 10 years to mature and we're
Hmm.
producing, let's say, like 3%. There is, 6-month treasury notes you could purchase as well that maybe would produce like 2% instead of 3. So the
Right.
reality is that it's not like there wasn't options for these banks. It's that these banks chose to,
Basically, be
bet
greedy.
everybody's money for that additional 1%. And then when the time came for people to withdraw their funds, they didn't have it because it's still locked in immature investments. And at the
Wow.
same time, the interest rate has been climbing. So those short-term treasury notes were actually producing higher interest than the 10-year bonds that these banks owned. So now
And
that
that's what they mean by like the inverted curve,
That's what
right?
the inverted yield curve is, yeah. So what that means is that the yield that you get for buying a short-term bond is now higher than the yield that you would get for buying a long-term bond, which is very uncharacteristic of bond trading. And
Right.
so what that means though is that if you're a bank, you already own these long-term bonds,
Hmm.
and now your clients want their money back, so you can sell the bond to somebody else who's willing to hold it until maturity before
Right.
you can't liquidate a bond. It's locked up for 10
Right.
years, but you can't. There is a secondary market, but
It's
on
like
that secondary
block staking.
market, yeah, exactly, yeah, but on that secondary market now you have these much shorter term bonds producing a higher yield. Who the hell is going to buy a 10-year bond
Right.
at cost if you could just create a 6-month T-note and make more yield? So what
So,
ended up happening is that all the money that they had put into these treasury bonds, the
mhm.
value of those bonds on the spot market where you can sell them, and make them liquid,
Mhm.
dropped like 20%.
No,
So then
yeah,
all of the but
and
effectively all the
that's
banks
huge
lost all
in
their
the
money. Yeah.
bond market when where things aren't volatile.
Yeah,
So
and so the Federal Reserve can step in, and for the average user of these banks, they won't even notice. So
right,
if
right,
you
right.
have your funds at a bank and you are seeing all this news about small
So
banks
it's all
failing,
FDIC insured.
you're fine
Usually.
unless you have over $250,000 in a single account. It's unlikely that you'll even notice that your bank failed, if it does
Because
fail.
it's probably going to get bought out
It,
by
it'll
JP Morgan
it'll be
at
bought
the end
out
of
by
the day.
someone else is going to buy it, and the
JP Morgan
operations.
is going to own everything.
Yeah, and the day-to-day operations to the end user who is just banking at that institution, they won't even notice. Like the bank
Right.
name, even though the bank went out of business, the name might not even change.
Right.
It'll just become operated by one of the bigger banks out there, and the Federal Reserve, like the FDIC, is going to step in and make sure that the day-to-day operations are uninterrupted. So as far
Hmm.
as like individuals out there who do bank with smaller banks, I don't think that there's a risk that you should be panicking or doing a run on your cash, but
Yeah.
it's good to be aware of the situation, because the real takeaway here is that short-term interest is really high. You
Right.
can, as an individual, you can open a money market account right now and make like 4, 5, sometimes even 6% interest on your cash at an FDIC insured bank
Hmm.
without a maturity term. So you could do that, for 3 days and then withdraw the money again.